Silver has just crossed a psychological barrier that many traders have been watching for months. $90 per ounce, a level that once sounded extreme, a level that many analysts dismissed. And yet, here we are. Silver has broken above 90 in the United States market, trading actively on the COMEX and reflected in spot prices across global platforms. The question now is no longer whether silver can rally. The real question is this: is $100 the next stop, or is this breakout setting up a sharp reversal? Pause for a moment and think about what this move really means. Silver is not just another commodity. It is both a monetary metal and an industrial input. It reacts to inflation, to currency weakness, to geopolitical tension, and at the same time it responds to solar panel demand, electronics manufacturing, electric vehicle production, and global industrial cycles. When silver breaks a major level like $90, it is not random. It is a message from multiple markets at once. Let us begin with the most recent catalyst. The latest U.S. Producer Price Index came in hotter than expected. That data reinforced the idea that inflation pressures are not fully contained. Markets that were pricing in aggressive rate cuts have started to hesitate. Bond yields reacted. The U.S. dollar firmed initially, and yet silver pushed higher. That tells you something important. This was not just a weak dollar rally. This was a structural move driven by inflation hedging and supply dynamics. Now consider the inventory side. Silver stocks held in COMEX-approved warehouses have fallen significantly compared to last year. Registered inventories, the metal readily available for delivery against futures contracts, have tightened. That matters because when futures prices rise alongside shrinking inventories, it signals that demand is not purely speculative. Physical market participants are active. When available supply narrows while price rises, that combination can create momentum that feeds on itself. At the same time, industrial demand remains strong. Solar energy installations continue to expand globally. Silver is a critical component in photovoltaic cells. Electric vehicle production also uses silver in electronics and battery management systems. Even consumer electronics contribute steady baseline demand. When you combine monetary demand from investors seeking protection with industrial demand from long-term structural growth, silver becomes uniquely explosive. But let us address the obvious question. Why $90? Why did this level matter so much? Round numbers in financial markets are psychological magnets. Traders place stop orders around them. Algorithms react to them. Media headlines amplify them. When silver pushed through 90 with conviction, it triggered short covering. Traders who were betting on resistance were forced to buy back positions. That added fuel. Volume expanded. Momentum indicators turned sharply upward. On technical charts, silver moved decisively above its 20-day, 50-day, and 200-day moving averages. That alignment signals a strong uptrend across short, medium, and long-term timeframes. Now the next resistance zone, many analysts are watching, sits between 95 and 100. The $100 mark is not just another number. It is symbolic. Triple digits in commodities attract global attention. If silver approaches 100, retail participation may surge. Exchange-traded funds tracking silver could see new inflows. Mining stocks could rally aggressively. The narrative would shift from cautious optimism to full-blown excitement. However, markets rarely move in straight lines. After a breakout, pullbacks are normal. Profit-taking is natural. Some traders who bought in the 70s and 80s will lock in gains. If silver retraces toward the 85 to 87 region, that would not automatically signal weakness. In fact, holding above former resistance can confirm a bullish structure. The key question is whether buyers defend dips. Let us also examine the macroeconomic landscape more closely. The Federal Reserve remains data-dependent. If inflation continues to surprise to the upside, rate cuts could be delayed. Higher rates typically strengthen the dollar and pressure metals. Yet, in the current environment, persistent inflation can also increase safe haven demand. This creates a tug of war. Silver's recent strength suggests that inflation hedging demand is currently winning. Geopolitical tensions add another layer. Trade disputes, tariff announcements, and regional conflicts have increased uncertainty. Investors often seek tangible assets during such periods. Gold traditionally benefits first, but silver tends to follow with greater volatility. Interestingly, in recent sessions, silver has outperformed gold on a percentage basis. That outperformance indicates risk-on momentum within the precious metal space. When silver leads, it often reflects stronger speculative conviction. Another critical factor is the gold-to-silver ratio. Historically, when this ratio declines, it signals silver outperforming gold. A falling ratio during a breakout phase suggests that investors are rotating into silver for higher beta exposure. If that trend continues, it strengthens the case for further upside. Now, let us talk about mining supply. Bringing new silver mines online is not quick. Permitting, exploration, financing, and construction take years. Many silver deposits are byproducts of base metal mining. meaning supply depends partly on copper, lead, and zinc production levels. If base metal output slows due to economic headwinds, silver supply growth could stagnate even as demand rises. That structural constraint supports higher prices over time. Recycling contributes additional supply, but recycling volumes tend to increase when prices rise significantly. If silver sustains levels above 90, scrap supply could increase modestly. However, recycling alone is unlikely to offset strong investment and industrial demand if momentum accelerates. Let us imagine two possible scenarios. In the bullish continuation scenario, silver consolidates briefly above 90, builds a base, and then pushes toward 95. If macro data continues to show inflation resilience and geopolitical tensions remain elevated, investors may increase allocations to precious metals. A decisive break above 95 could open the path toward 100 relatively quickly, especially if momentum traders re-enter aggressively. In such a case, volatility would likely expand. Intraday swings of several dollars could become common. In the alternative scenario, inflation cools unexpectedly. Upcoming economic data shows slower price growth. Bond yields drop not because of inflation fear, but because growth weakens. The dollar strengthens sharply. Risk appetite returns to equities. In that environment, silver could face a correction. A break below 85 might trigger deeper selling toward the high 70s. That would represent a healthy reset rather than the end of a longer-term bull market, but it would shake out late buyers. So which direction is more probable? At this moment, the balance of evidence leans bullish. Price structure is strong. Momentum indicators are positive. Inventories are tight. Industrial demand remains intact. Inflation pressures persist. Yet no rally is guaranteed. Markets are forward-looking. If traders begin to anticipate policy tightening or global slowdown, sentiment can shift quickly. There is also the speculative positioning factor. Futures data indicates that hedge funds have increased long exposure. That can amplify gains on the way up, but it also increases vulnerability if sentiment reverses. Crowded trades can unwind rapidly. Monitoring commitment of traders' reports in coming weeks will be crucial. Another element to watch is ETF flows. When retail and institutional investors buy shares of silver-backed ETFs, those funds must acquire physical metal. Rising ETF holdings would confirm sustained investment demand. Flat or declining holdings during price increases might suggest the move is more speculative than fundamental. Let us not forget currency dynamics. Silver is priced in US dollars. If the dollar index weakens, it can mechanically lift silver prices. Conversely, a strong dollar can cap gains. Currently, the dollar has shown resilience despite inflation surprises. If the dollar begins to weaken while inflation remains firm, that combination could be highly supportive for silver. There is also the psychological aspect of market cycles. Breakouts attract attention. Attention attracts participation. Participation fuels volatility. Volatility attracts traders. This feedback loop can drive prices beyond what traditional valuation models suggest. In past commodity cycles, parabolic phases often occurred after long consolidation periods. Silver spent years trading below previous highs. Breaking above 90 signals a new regime. Imagine headlines flashing across financial media. Silver approaches $100 for the first time in history. That narrative alone could drive speculative frenzy. Social media discussions would intensify. Retail trading platforms would report surging activity. Options markets would see expanded volumes. All of this creates self-reinforcing momentum. Yet disciplined investors must separate emotion from analysis. The path to 100 is possible, but it is not guaranteed. Technical confirmation above 95 would strengthen probability. Failure to hold 90 consistently would weaken the bullish case. In the near term, watch support around 88 to 90. Holding above that range suggests strength. Watch resistance around 95. A weekly close above 95 could accelerate upside momentum. Monitor macro data releases, particularly inflation, employment, and Federal Reserve commentary. Listen carefully to tone shifts. Longer term, structural drivers remain compelling. Green energy expansion, electrification trends, and technological growth continue to require silver.